Good afternoon and welcome, friends. We are back for your latest edition of Taking Stock on VOX Markets. I'm your host, Graham Neary. Please subscribe to the channel if you're new, smash that like button, and get ready for today's market roundup. I love Tuesdays and Wednesdays, they always keep us busy. Plenty to digest, probably too much for one mortal human to digest, in a single morning. But we'll do our best. We've got updates from a wide range of companies: Gear from Music, Mexican Grill, Jet2, 88 Energy, Breedon, Warpaint, Traxxas, Supreme, Filtronic. The list goes on. So it will be another one of those days where we do our best, but we may not get around to everything. We've got a couple of people in the live chat. We've got Informer asking about SRT Marine. We've got Matthew asking about Traxxas. So you're all very welcome, and appreciate the feedback in the live chat and in the comments under the replay. So where will we begin? I suppose let's begin with the most dramatic announcement of the day. So I will share the screen as per usual. Here's VOX Markets, and let's get into this this Filtronic announcement. So we're up 50% today, up with a market cap of £108 million. I was always a bit skeptical of this company, but how can we argue against this trading update today and a strategic agreement with SpaceX, no less? A long-term partnership with SpaceX. So if somebody had put out a range of unlikely announcements, I would say this would be one of the most unlikely announcements that I could have imagined. It's a commercial agreement with SpaceX, so it includes the ongoing supply of something called E-band solid-state power amplifiers, in addition to the development and supply of similar products at other frequency bands. And as part of the strategic partnership, the company is issuing a total of 21.7 million warrants to SpaceX to enable SpaceX to subscribe for up to a maximum of 10% of the company's existing share capital. So incredible news, and clearly going to have long-term ramifications for Filtronic, which will be, will be a completely different business, perhaps by the end of all this. The CEO of Filtronic says that he's delighted to enter into the agreement. Of course, this milestone development underlines our core value proposition of high-quality engineering and operational excellence. And we've got the SpaceX Vice President of Starlink saying that Filtronic has been an outstanding supplier for Starlink. So congratulations to Filtronic. Looks like it will be operating on another level now. And you can see the historic financials here were quite small revenue, 16 million, and very low levels of profitability. But this does look to be a total game changer. So just goes to show the skeptics like me get it wrong sometimes, and companies can blow us out of the water with incredibly positive announcements sometimes. But the long-term consequences of this deal are difficult to predict, but amazing news for Filtronic. So I just thought I'd get that out of the way with a positive news story. Difficult to quantify the long-term effects, but definitely a positive news story. Okay, where will we go next? Please let me know if you have any suggestions for what order you would like me to look at these stocks in. Um, let's head on over to Jet2 because I know that Jet2 has a lot of followers, and rightly so. It's been an incredibly successful investment over the long term. Market cap now at £3 billion. Shares are down 6% today because there has been a little bit of caution around this trading update. So the trading update was pretty good. They say that they expected to report profit before tax, and adjusted profit of 515 to 520 million pounds, which is actually in line with expectations. So that is not a problem. But I think the problem is just around what they say about pricing. So there's this paragraph of the trading update here where they say booked to date pricing for summer 2024 is showing a modest increase compared to the same period last year, which is helping to mitigate previously announced increases in input costs, although recently pricing has been more competitive, particularly for April and May departures. So that seems to have spooked people a little bit. There's been some mainstream press reporting on this, and there are suggestions that even though the tourism industry has been booming in terms of people leaving the UK, maybe people are reaching a limit in terms of what they can afford, because after all, there is a cost of living crisis which is affecting most people, and so foreign holidays, people will pay for a foreign holiday, but maybe they are reaching a limit of what they're able to pay. So that's the issue there. I mean, overall, the metrics here seem pretty good. We've got seat capacity 12% higher. The season is mostly sold, 55%, with average load factors ahead of the prior year. And they are saying healthy demand from flight-only passengers, for which bookings are currently up by over 18%. So I suppose that is not a. They probably prefer to have more strength in package holiday customers rather than flight-only customers. Informer in the comments says there is no cost of living crisis anymore. Yeah, I mean, certainly inflation has calmed down, but I don't know if I'd agree that it's completely over. But certainly open to that argument. So in terms of this update, a pretty good update, but maybe a little bit of profit taking as well. Jet2 shares have been performing very well. You can see this 1 year chart. They've increased from £10 all the way up to £15. So with such a strong share price over the past year, it's understandable that people might take profits on a slightly cautious trading update. But a very successful investment, this one. And even though it's a 3 billion market cap, it does have a big following among private investors because, of course, it was a small cap not that long ago. So that's Jet2, an interesting update, giving us a little bit of flavor in terms of the tourism sector. Let's go over and look at let's do Warpaint. I know Paul Scott has covered this over at Stockopedia, where I was also covering a few companies this morning. Warpaint, remarkable track record here in terms of share price growth, a multi-bagger, and people have done very well out of this one. Shares are up 6% today. So I suppose the question with Warpaint now is whether it may have possibly run away a little bit too quickly. Is it possibly in overvalued territory now? We've got full year results. So bear in mind, the market cap now is pushing £400 million. You can see they've made sales last year, 2023, of £89.6 million, with a profit before tax of £18 million. So is it growing fast enough to justify a valuation of nearly £400 million? Well, you can see we've got sales growth of 40%. So, I mean, 40% for me is, that is what I would want and expect from any high growth share. Extremely impressive. So, if that can be sustained for a few years, then yes, I think it can justify a £400 million market cap. You can see they're also paying a dividend, which I would say they don't really have to as a growth share, but they're doing it anyway. Earnings per share of 18p. So they're actually paying out half of their profits in dividends. Really strikes me as a bit strange for a high growth company to do that, but I guess it reflects what shareholders want. You can see they've got their own brand, W7. This is a copycat makeup brand. So they are, it's essentially imitating the luxury brands and the high-end brands with a cheap copy. But they do it successfully, they do it legally, and very well. You can see that's gone up 47% sales of their own branded products, with W7, their main brand, up 64%. So that is a remarkable growth rate. And so when you have this sort of growth rate, you can't really use a PE multiple very reliably, in my opinion. So, even if you looked at it and said it's trading at 20 times profit before tax, or 25 times earnings multiple, or whatever, who knows where this is going to be in a few years with growth rates of 50% plus. It's just an incredible success. We've got super drug stores selling them now. We've got New Look rolling out it to 200 new stores in 2023. And in terms of the new year, they say there's continued strong trading in Q1. Margins were robust and better than 2023. Still no debt, even though they're paying out half of their profits in dividends. They've got no debt. They've got cash of £7.5 million. They've got continued brand sales momentum, and a significant Christmas order received from Walmart. So it's hard to find. This is pretty much everything you want, I think, as an investor in this type of business. It's just a perfect situation, a perfect rollout, totally immaculate execution. Big name retailers stocking them, more lining up, more super drugs. And we've got Tesco mentioned. It's just an incredible success. Obviously, the market has been trying to price in the success with a £400 million market cap. Is that reasonable? I mean, I could see arguments that this is worth more than £400 million, but it is in the more aggressive sector now, where you do have to be a believer to buy the shares at this valuation. But yeah, why not? I think it's growing 50% plus the W7 brand, and that means this runway could just keep going. So, well done to Warpaint. What else is there to be said? Perfect performance by the company in 2023, and with continued momentum in Q1 2024. So that's Warpaint. Well done to them. Now, somebody, was it Matthew, was asking about Traxxas. So I suppose we can prioritize Traxxas and check them out. So these shares are down 3% today. And yeah, this is one where I have been a little bit lukewarm on these. I think on Stockopedia, I've been giving them an amber rating, or an amber color, just saying that I'm neutral on them. What do? They provide software technologies for rail traffic data and the wider transportation sector. This is a type of stock that I do like. I'm a bit late to the party, but I can, I've been looking into it, and I can totally see that this should be a big growth sector long term. However, Traxxas, you can see from these numbers why I've been a little bit lukewarm. They've had quite a lot of acquisitions over the years, but it seems to me that when they aren't doing their acquisitions, their growth becomes rather limited. You can see here that revenue actually fell in H1 by nearly 7% compared to the prior year. Also, they use adjusted EBITDA as their sort of leading profit number. But then when you scroll down to the statutory results, you see that there's an operating loss for H1 2024. You also see that their H1 profit last year was only a fraction of their H1 adjusted EBITDA. So, I mean, all of this can be defended, but it just leaves me a little bit lukewarm, because it's not exactly the type of thing that I'm looking for in shares. They do pay a dividend, and this performance, it must be said, is in line with expectations. So certainly an interesting company, and it definitely has some potential, but just those financial numbers, they do leave me a little bit lukewarm. And it's not just these numbers. I have studied the company before, and I sort of came to the same conclusion that revenue growth was rather limited in the absence of acquisitions. You can see they have various reasons they give here. They say total revenue decreased by 7%, driven by the non-repeat of a software license that they sold the previous year. And they say FY24 revenue growth will be weighted towards H2, reflecting milestone delivery timelines in the order book and the SaaS contracts in America. So, look, these are pretty reasonable reasons to give, but at the end of the day, it's, even accepting these reasons as being perfectly valid, it's still not a high growth story, which you would kind of hope for in the transport technology business. You'd be hoping for something more inspiring. I will note there are positives. There are definitely some positives in the story. We've got a strong debt-free balance sheet. And in terms of the pipeline and the outlook, there's plenty of positivity here. They say there's high activity levels across both divisions. There's further growth in rail technology post-period end. They say the end market drivers are strong, and they say there's a growing pipeline of M&A opportunities. So it seems to me as if this is primarily an M&A, mergers and acquisitions investment, where if they keep making successful deals, that's how they will grow. The underlying growth doesn't really seem to be there overall. But certainly not a bad company by any means. An interesting company, but just leaves me a little bit lukewarm. I've been quite consistent on that. So I'm gonna that's my view, and that's my story, and I'm sticking to it for now. But you can see market cap £250 million almost, a decent business, and worth having a look at. But Matthew and anyone else who's interested in that, please let me know if I've missed something, if I've missed reasons for optimism on this one. Okay, so that's Traxxas. Let's hop on over to Gear for Music, G4M. These shares are up by 7%. Small company, market cap 31 million. This is another one where, see, Paul Scott's a big fan of this one, or at least has used to be. I know things have changed, but this one is one where I think I've been fairly skeptical on it over the years, mostly because I sort of view it as not really having much pricing power. So it kind of, I just think it's very difficult to make good margins selling musical instruments like this without having any brand power. As I say, you can see that UK sales are up by 1% in the 12 months to March 2024. So that's, I mean, look, we've been talking a lot about how many companies have struggled in 2023. Hopefully things have improved a little bit for UK revenues more recently, but companies have definitely struggled last year. So 1% growth, not a huge surprise. You can see European and rest of the world sales actually down by 12%. And that reflects, as they say here, the prioritization of gross margins, profitability, and net debt reduction ahead of sales growth. I think that's a really important theme that maybe we should dwell on for a moment. You know, there was a boom in e-commerce shares in recent years. I'm thinking especially of AO World, where I was a huge skeptic of that one. And then all of a sudden they changed their tune. And I know I'm digressing a little bit by talking about AO World, but I just want to make the point that investors were putting huge valuations on e-commerce stocks on the basis of sales growth, even though there weren't any profits. And maybe Gear for Music is going to follow the path of AO World now and actually focus on profitability rather than sales growth. And it almost requires a change in the shareholder base, because a lot of shareholders are investing for growth rather than profitability. So that makes it difficult for the company to say, well, actually, we don't want sales growth anymore. We want profits. So you can see sales are actually down by 5% here. But it's based on the fact that they want profitability and net debt reduction. Same story with AO World. You know, they were running out of cash at one point, and they needed to get a grip on it, which they did. So Gear for Music, same thing. We want to reduce net debt. Now, I don't think that Gear for Music is in any financial distress here. I mean, net debt of £7 million is not much in the context of the company, but that is reduced from £14.5 million in March 23 and 24 million pounds in March 22. So you can see that they've been working very hard to get that number to a reasonable level. So now it is quite, now you can say, well, that looked quite safe. But at 24 million pounds, maybe it wasn't so safe. They say EBITDA is expected in line with market expectations. We've got a footnote here telling us that adjusted EBITDA is expected at 10 million pounds, 9.8, which is actually higher than the net debt position. So in other words, the leverage multiple here is probably less than 1 times, which people would consider to be safe. Certainly I would for most companies. So looks to me as if they've got things under control here. And they say planned cost reductions delivered in H2 will support further net debt reduction and profitability improvements. So it's really a company that's being run for net debt reduction and profitability rather than sales growth. And that to me is a positive thing, because at some point you have to do that. Every company has to do it at some point. But I suppose many companies want to put off the day when they do that because they want to grow as much as they can. In terms of the CEO comment here, he's just reiterating what's said above. So probably no point in repeating that. But yeah, an interesting update from Gear for Music. They are, I would say, on a good track there. Still, they still have a lot to prove, I would say. If you look at the expectations, adjusted profit before tax of 1.3 million pounds is still pretty low, considering the revenues are 144 million pounds expected. So very low conversion of revenues to profitability, which goes back to the low margin point that I said at the outset, and also a very wide gap between adjusted EBITDA and adjusted profit before tax. So in fact, that 1.3 million figure is also adjusted. So the actual profit before tax will be some other number. So they still have a lot to prove in terms of generating real consistent profits, but at least they are working on it, which is more than can be said for some companies. Okay, so that is Gear for Music. Nice company to keep an eye on. Where will we go next? Take a quick look at Tortilla Mexican Grill. Another small company now. Market cap only 17 million pounds. Shares down 3% today. So we've got annual results. And I mean, my general view on restaurants is I love being a customer. I'm sure being a staff member is great for some people, but being an investor in restaurant businesses, I think, is a tough road. But let's see if Mexican Grill can offer us some positivity. We've got revenues up 14%. However, we've got like-for-like revenue growth of only 3.6%, or 5% if you adjust for VAT rates. So remember, folks, with all the inflation we've got going on, especially last year, we wanted to see decent like-for-like revenue growth at companies. This is okay, not bad by any means, but the company uses adjusted EBITDA, which I find problematic for capital-intensive business, such as a restaurant business. and we have a loss before tax of £1.1 million. So tricky. It's just very difficult for restaurants to give clean profits. That's my experience, and this is sort of confirming my biases here. Any other points I want to make about this one? Yeah, so we've got an operating profit. Let's see, where have we got operating profit? Let's scroll down to the financial statements here. Okay, so here we've got a bridge from profit from operations to adjusted EBITDA. And you can see that the biggest add back is depreciation, £8 million. So that is a huge number, obviously, £8 million. Remember, the market cap here is only what, £17 million. So we've got depreciation of basically half the market cap in a year. And so for me, ignoring this number is just a no-go. You can't ignore that number. I also wanted to point out that operating profit of 684,000. So I think that's the same as the profit from operations we just looked at up here. Profit from operations, 684,000. And then in the income statement, we've got operating profit, 684,000. That number is also not even particularly useful in my view, because we've got a finance expense of £1.8 million, which has to be deducted from that. And then if you scroll down to the footnotes, as I did earlier, you'll find that this finance expense is mostly rents, basically, finance cost on lease liabilities. So the operating profit excludes a large portion of the rent under modern accounting rules. So we can't really use operating profit anymore for this type of business. So unfortunately, this company is confirming my biases, but as an investment, I'm sure it's a fine company. But as an investment, it's sort of confirming my view that restaurants are too difficult. Phil in the comments says that the Tortilla brand is just a bit dull for me. Chilango seems more exciting, but Tortilla is a little weak. There's one local in the city, and it never seems particularly busy. Oh, thank you for the insight. Of course, Chilango, that was another interesting investment. Chilango, so interesting in the Chinese sense. Okay, let's move on to where will we go? We'll do Breedon, I think. This Breedon, BREE. Okay, so this is a vertically integrated construction materials group, possibly of interest for read across to the construction sector more generally. Oh, Paul Scott in the comments says Tortilla bought Chilango. Thank you, Paul. Okay, so let's check out Breedon. We've got an AGM trading update. And yeah, so in terms of read across to construction, we've got wet weather, which is a temporary factor. It doesn't really matter, I suppose. But also ongoing macroeconomic uncertainty being mentioned here. So hoping for the construction sector to pick up, obviously, but it's not really doesn't seem to be firing on all cylinders on the basis of this update. They say revenue is going to, or did reduce by 9% on a like-for-like basis in Q1. So, I mean, how much of this is macro uncertainty, and how much of it is weather? They say that in Great Britain, the trading conditions were particularly affected by the wet weather. They say that Ireland had a strong tendering season and is well positioned for the rest of the year, with mention of Northern Ireland there. And cement. Okay, so quite a bit to get your head around there. Doesn't read great to me. You're kind of left wondering, is this going to be another bad year for construction? But the chief executive says that the first quarter seasonally is the least significant period for Breedon. He also says we have laid good foundations for the remainder of the year, progressing pricing, pursuing efficiencies, completing 2 bolt-on acquisitions, and launching our 3rd platform by entering the US market. Okay, so look, probably with unchanged expectations, you can make arguments for and against this one. Down 4% today. I did have a look at this company's historic financials this morning to try and get a quick overview. I did note that they have been, Breedon Group have been profitable pretty much every year, and the valuation with a PE ratio of about 11 times, possibly quite reasonable. The return on equity here is not bad. So if you're bullish on construction, Breedon Group could be worth a look. But today's update a little bit mixed. Okay, let's. How are we doing for time? 37 minutes. Let's head over to One Spatial. One Spatial PLC. This is a global leader in providing software solutions and business applications for managing location and geospatial data. So I wouldn't describe that as a plain English description of the company, but they have this thing they call location master data management. And I just wanted to make a couple of points about this one. Without having a detailed understanding of what they do, I would point out that there were lots of positive things from a financial perspective here. We've got recurring revenue, 56% of total revenues, driven by year-on-year term license revenue growth of 60%. So positive. They've got they're launching a SaaS business. Okay, still very early stage. I noticed that there was 15% growth in gross profit, despite only an 8% increase in revenue. So signs of benefits of scale and higher margins there. And an annualized recurring revenue of £17 million. So if we treat this as a software business, which it is, but just try and compare it to other software businesses. We've got a market cap of £65 million, and we've got ARR of £17 million. So straight away, you're saying, well, that multiple, if you value that on a multiple of annualized recurring revenue, we've got a decent multiple there. 65 divided by 17. So that's 3.8 times. So for, if you put that in an American context, you'd say many software businesses would trade at 5, 6, 7 times ARR quite easily. So if this is trading at 3.8 times, that's a good start if we're trying to build a case for this. I think the main negative that I spotted was just the inflationary costs mentioned here. So operating profit only grew slightly, but then companies like this are often not valued on operating profit; they're valued on ARR. Software business with annualized recurring revenue. I mean, if they could position themselves as a SaaS business, I'm sure that would go down even better with investors. So clearly they're trying to do a SaaS business. Net cash, not really material, £1 million, no big deal there. And in terms of the outlook, a solid start to trading in the current financial year with a growing sales pipeline and 2 significant framework agreements secured with the state of Texas and the UK Cabinet Office. Various other positive developments here. While cognizant of inflationary cost pressures, the board remains confident in delivering further progress in FY 2025 with a further growth step up in FY 2026 as the company benefits from the current ongoing investment. So, I mean, they don't exactly say that they are in line with expectations. There's just this mention of confident in delivering further progress. Yeah, it would be nice if they could say in line with expectations in the RNS. Just be more helpful. But overall, I think this is pretty interesting. From a valuation perspective, you'd say, if this is a decent quality business, why can't it trade at 5, 6, or 7 times annualized recurring revenue? Given we've got decent revenue growth, decent gross profit growth. Okay, operating profit hasn't kept up, but operating profit probably you'd want to see that higher, but why can't it trade a bit better than 3.8 times annualized recurring revenue? That would be my view, and so an interesting one, worth researching in a little bit more detail, I would say. Okay, where will we go next? We've already done 43 minutes here. Let's hop onto the VOX Markets homepage. Just remind you what's being covered here. We've got Supreme. We've got Paul Hill covering Supreme. This is one I've written about before in terms of the vaping situation. So yeah, check out Paul Hill's coverage of Supreme. I think I've been pretty positive on this one, but then I do tend to be a bit more relaxed about regulatory risk than other investors, so to bear that in mind. But yeah, I've been pretty positive on this one, and we've got Paul Hill covering it there on the VOX website. We've got lots of other news here. Nichols, I covered Nichols on Stockopedia this morning. Very nice business. Revenues falling temporarily, I hope. We've got coverage of Warpaint here. And in terms of the most read RNS, the top RNS today is from Angle PLC. Funnily enough, the contract size isn't huge here. It's £150,000 for a 6-month development phase, but hopefully that's just for starters. We'll see what it leads to. Angle is a liquid biopsy company, so cancer tests, for example, and yeah, I thought this was a low value contract, but could be significant for the future. It's with AstraZeneca. The chief executive says this is Angle's second large pharma company agreement of 2024 as we look to drive a significant expansion of the pharma services business. And we've got the Angle Chief Scientific Officer who says, we are delighted that our expertise in CTC assay development continues to make great strides. So, an interest, a promising announcement. Will it lead to big things? Let's hope so. So that's Angle PLC. Let's just check. We've got the shares up 31% today. Market cap of £42 million. So investors clearly pumped about that announcement. What else we got here? Space and People. Is this still very low market cap? Yeah, that's still a tiny market cap. Space and People. And we've got Jet2 is in here. I did read the Lloyds Banking Group Q1 interim management statement, but unfortunately, I didn't find anything that was worth sharing with you good people. As I've said before, I do find the banks rather incomprehensible at times. Not their fault, just the nature of the beast. 88 Energy did manage to raise 8.9 million Australian dollars. So well done to them. And as mentioned the other day, we go back and we've got people also very interested in Warpaint. So nice mix of RNS there. So was there anything else on the agenda? No, I think I'll leave it at that there for today, folks. Thank you very much for joining me. Please smash the like button. And thank you for all the comments. We had Phil, Informer, Matthew, and Paul in the comments today. So thank you all very much for your feedback. We'll be back tomorrow at the usual time, and I look forward to seeing you then, 12:30. And enjoy the rest of your day. And with that, I will leave you with the outro. Thanks very much. Bye for now.